Welcome back to part 2 of our video seminar series. This section I'll be presenting to you is about proper valuation and marketability analysis for your business. We'll be talking about the proper business valuation with the right metrics. This is a very important step in the process of selling a business, so we want to take a little time to go into it a little bit more in depth. What is the most pressing concern for a business owner when they're looking to sell their business? And a recent study says that it's proper valuation. It's getting the most dollars for the business that you've built up over the years. So what do you need to know when we talk about this? Business owners need to know what is the current value of their business. More importantly, what are the marketability factors that will affect a deal structure and the attractiveness in the market. So it's not just the number, it's the marketability of the business. So we want to talk about current market conditions. We want to talk about potential deal structures. We want to talk about tax implications, fees that are required in the process. How do we maintain confidentiality? And of course, the time frame that's involved both to sell the business, but also transition. How long will the business owner need to stay after a deal is closed? Does the sale of a business meet your goals? The only way to assure that is to understand exactly what you can get in the open market for that business and what that transaction looks like for you. So it does start with proper valuation. Very famous business owner once said, you've got to know where you are and where you want to go and then determine how to get there. So Mr. Gates was right with that, and we certainly want to have that approach be the same for you. I call it the valuation mindset. Business owners keep track of so many things throughout their daily lives in the business: revenue, profit, payroll, margins, all of these things. But we want to implore to you that it's also important to understand the value of the business that you're building. So some of the things that need to be kept in mind are, what is the definition of the valuation? What does that mean, and the typical uses? You've all heard about rules of thumb. We'll talk a little bit about that. Seller's discretionary cash flow, very important aspect of what we're talking about in goodwill. Multiple valuation approaches, positive value drivers, and marketability. What are the factors about your business that drive value in a positive way and hold it back in a negative way? What are the benefits of a valuation to the buyer and the seller as well? And what you should look for when you are looking at putting a proper valuation in place. Bottom line is, it's a proactive approach, and the efficient transaction is the goal. And the efficient transaction is one that quickly maximizes financial return with the proper buyer in a professional and confidential manner. So that's what we're looking to accomplish, and you have to take a proactive approach when it does come time to go down this road. So what is the definition for the seller? Proper business valuation analytically determines the fair market value of your company as an ongoing concern, and that's very important. Somebody is going to be picking up your business that you've been running for 10, 20, or 30 years and move forward with it. What is the value to them to take that risk and step into your shoes and move forward with the business? I'm sure we all have seen Shark Tank and very familiar with internet stocks and the public stock market. This is not that. We are in the private market, and the business has to make sense for a buyer to step up and pay you the proper valuation. So that is the definition that we have to work with, and that's what we're going to talk about here. So there's different uses for evaluation. One can be strategic. One can be very plan-oriented, meaning that you're not looking to sell right away. It can be used for different purposes, setting up a business for a potential sale down the line, business coaching, financing, growth applications, those kinds of things, partnership disputes, partnership setting up, buy-sell insurance, those kinds of things. That would go into the strategic bucket. The transactional valuation is for somebody that comes to us and says, we're looking to sell right away. We're looking to go into the market and execute a sale. It's the same valuation in the end, but it's just the difference is the use that we're going to be applying it for. It can be strategic, long-term, or it can be transactional. Let's go right away into the market. Not all valuations are created equal. I've met many business owners over the years, and I've heard some of them say, I know the value of my firm and I know the buyer. Unfortunately, that is a difficult approach, one that I don't agree with. It's probably based on rules of thumb that they've heard somewhere along the line, or recent conversations that they might have had with a person in their industry. And it can be okay for conversation, but it is very risky. Rules of thumb are generally not accurate, basically put together based on only one way of looking at the business, and certainly not recognized by the IRS or the banks or any buyer that is going to fulfill the transaction. The danger is if the value is too low, then you're leaving money on the table. If the value is too high, then you are risking taking a long amount of time, banging your head against the wall, trying to sell a business that's overpriced and will never sell. When it does come time to sell your business, there's certainly no reason to guess. Why would we want to? We want to maximize that value based on appropriate metrics and have something that is going to be actually executable in the market. So the rules of thumb are a pothole that we have to be aware of, and that's certainly to be kept in mind as we move forward. Every business is unique. I've heard this from almost every business owner that I've sat down with, and it's very important that we take that same approach in terms of valuing the company. Why would we want to take a one-size-fits-all approach to your unique business? The business is unique, and so is its market value. When we look at a business for evaluation, we're looking at the assets, the operations, and the cash flow. Tangible assets are defined first. Those are the things that you can touch and feel, like a vehicle fleet, computers, racks, furniture, those kinds of things. We're looking at an operational interview. We want to understand the business from an operational point of view, organizational, clients, history, potential, growth story. All of those things need to be looked at within the context of the financials that you're going to be providing. The financials alone do not tell the story. It has to be a marriage between the operations and the financial. What we're looking at in the end is the true benefit of ownership. Seller's discretionary cash flow is very important to identify, and we will go into this a little bit more in detail. But when you look at your business, you want to identify what is the true benefit of ownership. If you're billing $1 million a year, how much of that comes to you in one way or another? And we'll dive into that. Pretty much another way to look at it is what is the cash flow that's generated from the tangible assets? What are you doing with that fleet? What are you doing with those computers? What are you doing with your website and those kinds of things to generate the cash flow to you as the business owner? And we'll talk about that. Another very successful business owner, Mr. Buffett, said cash flow is king because it shows the true profitability and real ability to continue operations. That goes back to our talk about the definition of evaluation as being an ongoing concern. What is it worth as an ongoing concern? And cash flow, meaning the benefit of ownership, is what really drives that value proposition for a buyer. Let's talk about seller's discretionary cash flow. We look at a 7-year period when we are doing evaluation, 3 years in the past, the current year, and the projected 3 years that will follow. We're looking at items that are readily available on your tax return, and then we're also adding in those items that are buried within that tax return. So what are the things that are readily available on the tax return? Obviously, your net income from operations, your revenue, we're looking at that. The net income, your margins are right there, gross profit as well as net. We're looking at owner's salary if it's not a distribution. We're looking at depreciation, amortization, interest. All of those things are right there on your first page of your tax return. Some of the other things that might be buried in the tax return are other owner benefits such as cars, travel, health insurance, life insurance, any one-time or unusual events. Some people spend for a business coach. Some spend on marketing activities that might be completely discretionary. Entertainment, sports activities or sports tickets, those kinds of things. We need to identify, when we're looking at a business, all of the things that go into making up seller's discretionary cash flow. We're also then going to normalize your salary as the business owner. You need to be replaced. There are certain functions that you are responsible for within the business, and we have to figure out, are those going to need to be replaced by a new owner? We need to normalize for those things as well. So on this slide, the red items are normally buried in the tax returns. The white items are very apparent in the tax returns. One of the other things we're looking at is rent adjustments. Many times the business owner owns the property. We need to look at whether or not they're overpaying or underpaying rent and what would be the market rent conditions moving forward for a sale. So the real estate, while that's not being appraised, does need to be looked at to make sure that the component for rent is being taken into consideration. This is a dialogue between our managing director and yourself to go in and make sure that we're extracting properly all of those items that make up seller's discretionary cash flow and ultimately drive the value of the business. So what are some of the hallmarks of a truly useful business appraisal? Number one, it should be independent, third party. Quite frankly, my opinion would not count in the marketplace. Your opinion would not count. Your CPA's opinion would not count. Not that we can't accurately value the company, but when it comes to buyers and the banks, they don't want to hear from us. So a proper valuation needs to be done by an independent third party, accredited valuation firm, recognized by the investment community, recognized by the banking community. In addition, it has to be multidimensional. We can't be looking at a firm just in one way. We're looking at the business from an asset point of view, from an income point of view, and a market-based point of view. We're looking at about 7 different factors that will be looked at that will indicate a value, and the valuation company will subjectively apply a weighting to those values depending upon the business and extract a proper valuation. It's important to know that your business has to be valued relative to other businesses in the same sector. So a retail operation will not be compared to a manufacturing company or an engineering firm. You get the point. It has to be relative to your particular SIC code, your particular industry. It's very important that the business is valued in that way, and that's done by the multidimensional approach. Another important factor in evaluation is that it needs to look at the transaction from a buyer's point of view. We are an M&A organization tasked with selling businesses. It has to be attractive to a buyer. We want to maximize that value in a proper way, but it has to make sense to a buyer. So a valuation that has any meaning to it will include a page which looks at the total return on an investment by a buyer. What do they take out of their pocket, and what are they expecting to get in return once all of their expenses are paid that are associated with the transaction? So much as you will track your rate of return on your investment in Google or Apple or Microsoft, a buyer of a business is going to want to do the same thing. And generally, we're looking at a spread between 30% and 60% as being an attractive rate of return on their investment. In this case, we have a out-of-pocket expense from a buyer of $666,000, but they're going to have expenses that are related to the purchase, debt service, replacing your salary, that kind of thing. When all is said and done, based upon the free cash flow of the business, they're going to have $254,000 left over when all is said and done. Relative to their investment out of their pocket of the $666, comes out to a 38% rate of return. That's attractive. It falls within that rate of 30 to 60%, and that shows us that the valuation falls within the parameter and it's not overvalued or undervalued. It falls as an attractive investment in the marketplace. So once again, it's important that this component be included in evaluation. What would a business look like from the buyer's point of view? Lastly, a proper valuation should identify the value drivers. We talked about marketability, and a proper valuation should be a call to action for a business owner. It should lay out the positive and negative aspects of the business which will hold down value or increase value. As a business owner, you need to know the problems that need to be solved so you can go and properly position your business for sale. If a valuation does not address these things, then it is selling itself short. It's not giving you the full realm of the information you need. Marketability analysis and leverage going into the marketplace is going to have a direct impact on a deal structure and cash that you receive at closing. Very important that as part of the valuation process, you receive this information. So, what are some of these factors that drive the value of a business? And some are very apparent, some are a little bit more involved. Optimum profit margins within your industry, how you compare with others, consistent growth, the potential for growth, and a competitive advantage. You need to know your competitive advantage, your unique selling proposition, what sets you apart. What are the factors that set you apart from the competition? We need to be able to identify these, and we need to be able to exploit these or to magnify these when we're going into the market. We need to have established operating systems. We would like to have a diverse customer base without any concentration, if that's possible. Stable team of management and ownership that work together, but the management that can step up when the owner steps away from the business. So that's very attractive to a buyer, that there's a management team that can fill the void of the existing owner that's leaving the company. Accurate financial systems are important. We don't need audited financial statements, but we do need regular interim financials that are accurate, that are done by internal bookkeeper with QuickBooks, reviewed by accounts. We need financial tax returns that are up to date. That is very important, especially when we go into a sale. We need to be able to keep up with the financials and make sure that we're providing up-to-date information as we go through the process. Lastly, attractive facility and flexible lease terms, along with attractive growth potential and projections, are very important. We need to have flexibility. We need to show a buyer that we're willing to work with them. And we also need to show that there's growth ahead of them and that they can take this business to the next level and get the business to its full and maximum value for them after they buy from you. Bottom line is we want to maximize the negotiating leverage. Bottom line is if we go in weak, we're going to get a lesser deal. If we go in strong, we're in a better position to dictate terms, get more cash at closing, get a more favorable deal for the seller. So what would be the benefits to the business owner of putting in place a proper valuation? I always say it comes down to peace of mind and control of the process. It's a very, very important step. The information that comes from a valuation to a business owner as they contemplate a sale. The benefits, as I said, really come down to it answers the all-important question correctly. What is my business worth? Without guessing, without guesswork, putting something in place that has meaning and weight in the market. It provides feedback on the value drivers, identifies the marketability of the firm so we can talk to you about what can and can't be done. It simplifies and demystifies the process. I've worked with many business owners over the years, and they always seem to be empowered by learning about the process of what their business is worth and the process of how they're going to sell their business. Going into it, they have no idea. They know how to run their business. They know how to maximize their business and run it, but they don't know how to sell it. If we can impart to them the information that fills in those gaps, then that can be very empowering to a business owner. As I said before, it enhances the negotiating leverage. We want to have the ammunition to go into the market strong and extract the maximum value. It enables faster sales with higher returns. If we can sell a business in 6 months as opposed to 9 months because we have the proper valuation in place and we have the proper financials and proper marketing documents in place, then that is immeasurable. Time is the enemy of every deal, and we want to be able to execute things in a quick and efficient manner. As I said, the efficient transaction is the goal. We want to control this process. This is your business. It's not the buyer's business. It's your business. You're only probably going to do this one time. We want to do it right, and we want to control the process. That's the primary benefit of putting in place a correct valuation of your business. So if we still think that it might not be needed, we would say try to attempt a sale without one. Quite a mission impossible. We've seen this many times throughout our years here, and many business owners have come back to us after trying to sell a business on their own without putting a proper valuation in place. Quite a daunting task. Some of the pitfalls are you're not being taken seriously by a buyer. There's no asking price justification for what you're asking for. Could be pie in the sky, could be completely overvalued. There's no SBA or bank that is going to put in place the financing needed to close a transaction without a valuation in place. And by not being transparent with the buyers, not being transparent with the banks, you're really putting yourself behind the 8 ball in terms of time. Lost time equals lost opportunity equals lost dollars. Also, one of the things that you have to think about is there might be some seller's remorse. If you or anybody sells their business without knowing from an independent third party what the business is worth, there might be that nagging remorse of, did I leave money on the table? Did I sell myself short? Did I not get that full valuation? We want to have that conversation way ahead of time and making sure that you are fully informed so you don't have that thought. The last thing is, if the seller doesn't put a valuation in place, more than likely a buyer will. And if a buyer goes to a seller and says, we love the company, we love the operations, we love the organization, but we have a couple questions about the value. Would you mind if we put in place our own valuation and we'll pay for it? The buyer will pay for it. That's a very bad day for a seller, because whether you say yes or no, it's not a very good situation. If you say no, then the buyer wants to know, what are you hiding? And chances are the deal is lost. If you say yes, now you've basically given control of the entire process to the buyer for them to make up their own determination as to what the business is worth. We certainly don't want to be in that situation, so we want to be proactive, and that certainly is a very large pitfall if you decide not to do a valuation and try to effect a sale. Some of the things that need to be kept in mind as you might be looking to put in place a proper valuation. Is the valuation cost based upon gross revenue? Meaning, is there a sliding scale? Would you be paying for your valuation the same amount that a business 5 times as large as you is going to pay? Should be a sliding scale based on the size, the relative size of your business. Once again, is the valuation company independent and accredited? Need to verify that. Who are the people that you're going to be working with? I've talked a little bit about our organization. It's important that whether you deal with us or any other organization, that you know who you're dealing with and that they're going to be with you throughout the entire process. How is confidentiality protected? Very important. We want to maintain some discretion to make sure that there's a straight line between you and the people that you're going to be working with. No employee involvement, no site visits, nothing like that. Needs to be controlled in how confidentiality is maintained. Is there a marketability analysis? We are an M&A organization. We provide feedback relative to selling transactions. If you go online and get a valuation based on numbers, or your CPA puts together a valuation, more than likely they're not looking at it from a saleability, from a marketability point of view. That's very important to keep in mind, as I mentioned before. And what about moving forward? What if you don't sell right away? Are there updates, complimentary updates available, or lower priced updates available to you as you move forward? And then is the valuation cost going to be reimbursed at closing? All of these are questions that you should be asking a valuation company or an M&A advisor that you're looking at before you start this process. As you seek this information, keep in mind the answer to all of these questions should be yes. You should not forego your confidentiality or marketability analysis or anything when you're putting this together. All of these questions should be answered with an affirmative. There are options out there that will meet all of these requirements, and you should seek that out if you're looking at a proper sale. So what would be required for a business valuation? The company financials, as I mentioned, we're looking at the past 3 years. We're looking at the current year, so we're going to be looking at the last 3 years' tax returns and financials, as well as the current year interim financials with a comparison to the previous year. We're going to be looking at an approximate asset listing, not what you paid for your fleet of vehicles or your equipment, not what it would cost to replace those, but what the street value would be. What do you think those are worth now? So we want to have an approximate asset listing with street values of major equipment. We want to have a mental summation of the benefits. We talked about some of the items that are buried in seller's discretionary cash flow. We want to talk about, how much is being paid for personal vehicles, personal life insurance, medical insurance, all of the things that would benefit owner in one way or another. We want to talk about those things. We look for about an hour to 90 minutes of undisturbed time between our managing director and yourself to sit down, set aside the time, have a one-on-one conversation, operational interview about these things, and really get everything, hear what you have to say about your business, your goals, and put that all together along with the financials as part of the process. The valuation is complete, and the marketability information should be delivered within 30 days. If there's quick availability to the financials, there's no reason why a valuation shouldn't take more than 30 days. Bottom line is, proper valuation is the first and most important step in the process to selling a business. It should not be included with the sale of a business, meaning that you shouldn't have to commit to selling a business to get a valuation. With our firm, we offer the valuation without obligation to sell. It's our belief that the only way you can make a decision to sell is if you have that information, have all your questions answered ahead of time. And then once all of the items are addressed and you're comfortable, then we can move forward with a proper transaction, one that meets your goals on your terms, and us being fully informed about your business so we can represent you properly, and you being comfortable with the process so you have peace of mind, control of the process, and be comfortable that we're going to execute something in an efficient and quick way. So we encourage you, get the information you need and prepare to succeed now. We strive to provide you that information, and we look forward to working with you to continue the dialogue along those lines. I want to thank you for your time, and we look forward to answering your questions in the near future. Thanks.